And to discuss with us further the global financial market and the economy is Professor Charles Schell. He's a leading international business strategy and financial markets expert from Manchester Business School. So, Professor, the stock market for the average American is the simplest way to think about the economy. How bad is the U.S. economy right now, given the dwindling fortunes on Wall Street?
Well, it is interesting that the American economy has been leading us, has led us into the crisis, and people still pin hopes on the American economy to lead us out of the crisis. But if you're in the United States, you don't really get the sense of recession that you had in past recessions. Those of us who are old enough to have been around for the last couple of recessions remember a much deeper feeling of gloom throughout the economy. This recession started very differently in the financial sector, and for a lot of people it's still very much an unreal type of recession, unless you're working in certain sectors. The financial service sector, obviously. Some of the manufacturing sectors have been hit particularly hard. But something's fundamentally different in the United States this time around, and I think that's largely the fact that more people are working in the service sector. And a recession in the service sector feels a lot different than a recession felt in the past in the manufacturing sector.
Staying in the U.S., the Federal Reserve expects a contraction of between 0.5% and 1.3% for all of 2009. What's your own forecast?
Well, I'm very careful not to get drawn into forecasts for a couple of reasons. One of them is that the forecasts are irrelevant in real time. We don't really know what's happening in an economy until well after the period that we're studying. It's taken us almost a decade to figure out what the growth rates in the economy, or today we'd be talking about contractions, but the growth rates in the economy in the 1990s, we really didn't understand until well after the time, because we had a whole new economy that was growing in the background. We had the information technology businesses that were developing, and we had no idea to measure them. We should be looking today at the parts of the economy that we really can't measure, like, for example, the new green economy that's emerging and is partly being funded by some of the stimulus packages. We'll have a hard time measuring that as that develops. So if I had to pick a number, I would say that probably the Fed is, at the moment, and for the rest of the year, is probably on the light side. I would say that we're looking at least 1.5%, perhaps to 2%, but you'll have to come back in 10 years and tell me whether I got that number really right.
All right, thank you for that. Moving on, do you think the steps being taken by the Obama administration would be enough to jumpstart the economy?
I don't think that the government is going to be able to fix this by itself. I think there's a large measure of consumer sentiment that has to be behind any kind of a recovery. Certainly for markets to recover, we're looking for a number of conditions, perhaps as many as 4. Certainly we have to have liquidity in the markets, and I think as a lot of the big players, hedge funds and perhaps even private equity, looks for liquidity in the next while, we'll see liquidity in the markets as there's some forced selling. We'll probably also have to see some better prices in certain areas, and already in some sectors I think we see some very good prices. In the past, we've always looked for some kind of a major clue, something like, well, for the last 2 major recessions, we've had Gulf Wars to pull us out of recession. And so those things have been important, but especially important this time, we have to have a financial service sector that works.
5 months since the meltdown of Lehman Brothers, the financial industry's bellwethers haven't been able to right themselves. Why is that?
Well, I think we've gotten trapped into a vicious cycle. This started off with a couple of relatively minor classes of assets with the mortgage-backed securities. Perhaps today we're still looking at a bit of the fallout in the Alt-A market in the American mortgage business. But those assets, when they get knocked down in value, will start to take down the value of some of the banks. And then as a result, the banks have to sell off good assets, which decreases the value of the banks, and we go round and round into the next stage of a vicious cycle. As the banks stop lending, manufacturing businesses get into trouble, and some of the banks have had to go back for recapitalization, pushes down the value of the market, pushes down the value of assets, and as I say, again we go into the next round of the cycle. The question is, what's going to stop that? we have to have a very clear message from government, and I think government is in the United States is on the verge of producing some really important changes, perhaps creating a bank to hold some of the toxic assets of banks, and the recapitalization, the liquidity that we've seen go into the banks has certainly gone a long way towards resolving that.
Professor, I just want to get your thought on this. Should investors be abandoning the financial sector as it continues to bleed red ink?
It's a question of what they're going to abandon it for. People look for better alternatives before they move their money. We have very little reason to seek liquidity right now. The bank rates are very low. So what are you going to put your money in that's going to be any better? I think there's some good choices in the banking sector, certainly some better choices than others. For example, we saw the last couple of days Standard Chartered coming in with some good results, and they're going to be in a very good position to pick up some of the assets and perhaps some other banks as we go into hopefully the recovery stage.
Moving now to Asia, Japan's Prime Minister Taro Aso has proposed a $770 billion package to shore up the economy. Now, without the help from exports, can Japan pull itself out of the slump?
Of the economies in the region, Japan actually has surprisingly, one of the least trade-dependent economies. They have less than 20% of their economy of their GDP represented in exports. Now, that means that Japan and its own domestic spending is capable of pulling itself out of a hole. Now, I know that Japan's done a couple of other interesting things. Of all of the countries that have announced stimulus packages, they've produced one of the largest green stimulus measures. So they're looking on to the next level. They're thinking about what's going to happen beyond the recession and how they can actually turn this into some kind of a force for good.
From Japan, let's now move to China. Economic activities there have remained weak. Are there signs of recovery? What with the government's more than $500 billion stimulus package?
It's China's ability to stimulate its economy by throwing money at certain sectors is certainly an interesting question. You've got an economy that is still growing by almost 7%, and even by pessimistic measures will still be growing at 6% for the rest of the year. It has a huge need for infrastructure, especially in some of the areas away from the coast. And so I think that this stimulus was something that was necessary anyway, something that China needs to spend and can well afford to spend. And so as a result, this is doing the right thing at the right time, but not perhaps for the reasons of bailing out an economy. And as well, China is also looking at a very large proportion of green stimulus in its measures.
All right, on that note, thanks very much indeed for joining me this morning. That was Professor Charles Schell from Manchester Business School.